esteemed colleagues in the profession, joined in physical and virtually, and staff of SIRC, a warm welcome and good morning to all. Members, we are very immensely happy to have organized the first one-day physical program after COVID at SIRC, that too about evergreen topic, that is the partnership taxation. Every practicing member, as a chartered accountants, here aware about the taxation of the partnership form and the implication of admission and retirement of and reconstruction of the firm. But due to the latest amendments in the income tax regarding taxing of dividends in the hands of the shareholders and the formation of partnership firm has been a regular tax saving avenue for the many taxpayers. Besides, the amendments to the provisions applicable to partnership firm made this topic so live and very fresh every time. Members, today program is organizing keeping in the mind the latest amendments in the Income Tax Act through the Section 9B and 45(4) and 48 Clause 3. One cannot simply reading of this section may not be understand the implication of these sections together. These are the independent sections. Even we as a CA practitioner undertake the partners admissions, retirement and works very often. Now this tax impact has to be first understood before the legally affecting the same. Members, this is the opportunity for as a SIRC chairman to share the initiatives in the presence of our esteemed members. We just wanted the highlights about the SIRC. We initiated one INQ program at SIRC, that is the articleship placement program and campus placement program for recruiting graduates for our CA firms with the coordination of all the 45 branches. Members, so this program, we are happy to say that almost more than 1,000 students and recruited and more than 100 CA firms got benefited. Besides, we are attracting more than 100 colleges across from the southern region. The another INQ program at SIRC, that is Train and Learn, has been launched for the students, and more than 1,500 students got this benefit. And to encourage the students to register in our CA course, we had entered into MOUs with the 3 state governments, that is Telangana, Andhra and Karnataka, to get to conduct the career council program for the government schools and government aided schools and colleges. As apart from the above, the institutional social responsibility, we at SIRC granting 100% fees waiver for the students of government and government aided schools for our foundation courses. Also offering fee concession for deserving students who are in the need of the support. Members, one more important I want to share about this. The important is the proactive steps taken by SIRC in taking the legal action against one income tax practitioner at Karaikudi in Tamil Nadu state, who has been misrepresenting himself as a chartered accountant and even used one of the firm FRN details and using the institute emblem and giving the certificates. This complaint came to SIRC. We took that the bold steps are rapid steps. We sent the officials of SIRC to the respective local place, and the officials made the official complaint in the local police stations, and this income tax practitioner now is in the behind bars. This firm was originally, he is using this firm is located at Rajasthan state, but he is using the firm details in Tamil Nadu. So members, if any things like this this type of issues comes to your knowledge, let us share. SIRC and the institute and central council members and regional council members are very ready to undertake these issues and to address within a very short span of time. Members, I have a request to all of you. The first time of ICAI has been given the honor of hosting the 21st World Congress of Chartered Accountants between the 18th and 21st November 22 at Mumbai. I request all of you to register and share these program details at the local branches and to your friends also. Finally, members, this is the wonderful program with the right and highly resourceful person. I am sure at the end of the day with these participants, and you get more clarity on the subject of partnership firm taxations. I once again heartily offer a warm welcome and get the rich experience on this topic. Thank you all.
Thank you, Chairman, sir. Thank you for your welcome address. In fact, it's a good start, set a good start for our today's workshop. May I now request CA Rekha Umashav, Regional Council Member, SIRC of ICAI, to present a Kanchipuram Silk Shawl, Health Bouquet and Memento to our first technical session speaker, Dr. CAE Phalguna Kumar, sir. I request S. Rama Subramanian sir also to join the felicitation. May I now request Rekha Umashav, Regional Council Member, to formally introduce CA Dr. E. Phalguna Kumar, sir.
Very good morning to all the members on and off the dais. Respected past chairman, SIRC E. Phalguna Kumar, sir, Rama Subramanian sir from Bangalore. Very good morning to all of you. It is indeed a very prestigious moment for me to share the dais with E. Phalguna Kumar, sir. So to tell about the faculty and the facilitator for the day, Phalguna Kumar, I think it's a person who doesn't need any introduction. So Tirupati, if you see the first name that comes to you is Phalguna Kumar, sir. So sir is basically a practicing chartered accountant. And practicing chartered accountant, I should not stop with that. He has been practicing for more than 4 decades, 43 years. And he's also a managing partner of E. Phalguna Kumar and Co. And also he has other qualifications like MA, MCom, BA, BL, DISA, and even a PhD holder. He's also a member of the Institute of Company Secretaries of India. He's a qualified independent director with the Indian Institute of Corporate Affairs of MC of the Government of India. He was also a member of the Regional Direct Taxes Advisory Committee. He was also appointed as a member of the Board of Studies of SB University and also SB Mahila University for the period 2012-14. He represented more than 400 technical papers in income tax in the past various CP seminars in all the 4 southern states. I think that requires a big round of applause. And also on the GST, he has delivered more than 50 lectures across southern India. Most of his lectures can be viewed in YouTube. And he also got his doctorate, PhD in Accounting and Auditing Standards for the non-profit organizations from Sri Venkateshwara University, Tirupati. He is serving the society as a trustee and an executive member of several charitable institutions at Tirupati. He has been appointed as a finance committee member for 3 years, 2020 to 22 of IIT Allahabad, UP. And he was also a member of the Southern India Regional Council from 2010 to 19 and the chairman of SIRC for the year 2016-17. And he's married to Srimati Vijayalakshmi, who is a doctorate in home science and has worked as a principal of TGD College. We are blessed with 2 children, a son and a daughter. Both of them are qualified chartered accountants and practicing with the father. Daughter-in-law is also a practicing chartered accountant in this firm. And to tell more about sir, he's also a classical flute player. Today, on this occasion, we welcome you, sir, to this particular session, and we are much privileged to have you here. Thank you.
Now the floor is open to CA Dr. Kumar sir to handle the first technical session. Over to you, sir.
Does act and rules. So act and rules. Because I didn't. Right, and then act in 2021 at least. The rule came in the middle, so the rule should be 2022. Act in. Yes, so I doubt on that.
Esteemed Chairman of SIRC, Sri T. Chinamastan, Vice Chairman Pandas, Secretary Naresh Chandragaldi, and other executive members, Rekha Madam who is present here, and my co-speaker, senior member from Bangalore, Sri S. Phalguna sir, and those who are physically attending, senior members, ladies and gentlemen. As Chairman has given the introduction, as practitioners, day in and day out, we are dealing with partnership firms. The entity of partnership firm, even now, is just nearer to individual, having single taxation. If you go to a limited company, the income earned by the business of the company not only suffers in the company's hands, as we all know, again, the dividend shared is now taxable in the hands of recipient shareholders, whereas the partnership sharing is exempt. So that's why we choose day in and day out. In fact, for professionals, not necessarily business, for professionals also, most apart from individual, immediately we jump into the partnership firms. The Partnership Act 1932 is not recognizing the partnership firm as a separate legal entity, as we all know. So if a person lends to a firm, he can sue only the partner, rich partner, to recover his money, because firm and partners are not separately identified. For Income Tax Act, in the definition of person, we are seeing firm as a person and partners separately from the firm, and taxation is also separate. So now though 1961 Act has not envisaged the problem of transactions in between the firm and partners, over the years, because of a number of decisions that the transactions in between the partner and the firm are not to be looked into separately, they are not subjected to tax. So we are having the old decisions like Malabar Fisheries, where the transfer of property by the partner to the firm or from the firm to the partner were not earlier taxable. Only in 1987, the Section 45(3) and 45(4) were introduced in the Income Tax Act to bring to tax that partner contributing any asset to the firm at the value that is recorded in the books of accounts 45(3) and 45(4). At the time of dissolution or otherwise, if any assets are distributed at the fair market value, the firm has to pay the tax. So this 45(3) bringing in of the asset, 45(4) was there. Now these are all valid up to 2021, and now in 21 Finance Act, though it was introduced on February 1st, 21, the government proposal is making it applicable for assessment year 21-22. That means some transactions which have taken place already between 1/4/22, 1/2/21, unaware of these provisions are cut. So what is this proposal in this today 3 sessions? Easiest session, first one is taken by me or given to me only to explain the provisions, what are the intentions, and say what apparently we can understand from these provisions. The next speaker, Pradeep Kapasi sir from Mumbai, is going to have a critical analysis in the sense how many interpretations are possible, what are all the real difficulties, ground level difficulties will be there. And we're also having senior professional colleagues, S. Subramanian sir, with figures to analyze the application of these provisions. So today we call this as a workshop because not merely listening to the lecture, already you will find on this topic not less than 10 videos in the YouTube or say papers in the net. But the subject is so critical. Unless you work out something physically, it will not get registered in the brain. That's why we have taken this topic as a workshop. The dissolution, reconstitution, the two words. The dissolution was there, as I said, at the time of dissolution in 45(4). The partnership dissolution is dealt in the Partnership Act. In the Partnership Act from 39 to 44, you will find about the dissolutions, various types of dissolutions recognized by the Partnership Act. So, the present amendments are dealing with the transactions or the transfers in connection with the dissolution. They are not using the word on the occasion of dissolution. In 56(2)(7) or say 56(2)(10), which is now from 1819 Assessment Year, gives on the occasion of marriage, except. So the dissolution in connection with the dissolution, if the transfers takes place. So what is meant by dissolution in our common understanding? The partnership is by agreement. The firm is the front end of the partnership that is carrying on the business. So if the agreement collapses, that means the ceases, which comes to an end. The agreement with which the partnership has come into existence, if the agreement totally ceases, that means from that day onwards severed the relationship as partners. So then the firm is dissolved. So the dissolution can take place either as per the terms of the partnership deed, or if the event or say the task that is taken up by the firm is coming to an end, or if one of the partner is declared as insolvent, if all the partners have been declared as insolvent, or if the court finds dissolution is necessary, some fraud between the partners, so somebody will go to court. Court can say dissolve the firm. So the death, normally, unless otherwise there is a clause in the partnership deed, by the death of a partner, firm is supposed to dissolve. So the dissolution is one item taken here. In connection with the dissolution, the transactions which are envisaged in these three sections will come to tax liability. Then the reconstitution. Reconstitution is there in the Income Tax Act itself, section 187. So the reconstitution, the partner's constitution, either a new partner coming in, firm gets reconstituted. If an old partner is going out, it's a reconstitution. Not one coming, one going. Few may come, few may go. At least one old partner is continuing, the firm is continuing. Or same partners continue with a changing profit sharing ratio. Then also it is a reconstitution. So these are primary things once again in 9B specifically, they said. So though we are primarily talking about partnership forms, the amendments are saying that in the case of a specified entity, if a specified person receives in connection with the dissolution or reconstitution, either a capital asset or stock in trade, this is the first 9B section. So the 9B section is a new section. When the February 1st, 21, the finance bill was introduced, this 9B was not there. The old 45.4 was supplemented, intended to have another 45.4A. Whereas on March 23rd of 21, instead of 4A, 45.4A, they brought this 9B new section, which ultimately have become the law. So this 9 we know, the charging section 4, scope of total income section 5, and then we are having residence section 6, the other section 7, in the case of technical know-how, royalty, the incomes, section 8, the dividend, section 9, the deemed to arise, and now the 9B, in the case of a specified entity, transferring to a specified person, the deemed income. So why this 9B? So this 9B is covering both the capital asset and stock in trade. So this capital asset and stock in trade transfer, capital asset normally under the capital gains chapter, section 45, the charging section, and subsections are there. So it would have been limited, but now we will slowly try to understand why this 9B and then 45.4 and then the last 48 last 3. So this 9B is nothing but a revised or a modified version of the old 45.4. So as I told you, from 1988 we are having till 2021 the 45.3 for partners bringing in capital assets and the 45.4 for partners receiving the capital assets either at the time of dissolution or otherwise. So the government, what its intention would have been, many a number of persons invest in the partnership firm and after some time take more than what they invest, either in cash or in kind from the firm and getting away without paying any tax. For example, before these sections, if a partner invests 1 crore 10 years back, the firm would have carried on the business. Every year out of the profits, you would have withdrawn the profits, some part of the profits, or his capital would have been accumulating. The firm is having, say, movable properties, stock in trade, everything. So one day he wants to retire. So you would have been paid something more. What generally people are doing, if 1 crore is a original investment and 1 crore 50 lakhs he wants to withdraw, they will debit the goodwill 50 lakhs. They will credit the retiring partner's account 50 lakhs. Retiring partner's capital account is 1 crore 50 lakhs. The firm will pay the cash 1 crore 50 lakhs. Is the partner liable for what the extra money he has withdrawn? No. There is no section because partner, if he takes any at the time of any asset, capital asset, cash is not a capital asset. At the time of dissolution or otherwise only the provision, except that nothing is there. And in addition, what they debited the 50 lakhs goodwill, we have paid for the goodwill, claim the depreciation also. So in these 3 amendments which we are going to see, here afterwards goodwill will not have depreciation. So the tax planning, you call it, or say the way the act was there up to 2020 investment year, partners receiving more than their capital was not subject to tax. So how to bring it? Second, whenever a partner ceases to be a partner, either at the time of dissolution or on account of retirement, actually the definition of capitalist, if we see 214, the definition of capitalist is an exclusive definition. It says any property excluding the stock in trade, personal assets other than jewelry. They didn't stop with the stock in trade, the raw materials and consumable stores. In the definition of capital asset 214, the words used exclusion are any property excluding the 5 items, the gold bonds and these things, agricultural land which is situated beyond a particular. So the capital asset only is covered in 45(4) when a partner is taking. The cash, if a partner withdraws, is not liable for tax. And the partner, what he is doing? He is surrendering, he is losing, or he is transferring, he is retiring, means this is share in the partnership form. Because the law all these days, whether it is a Mohan Bhai, Kumar Bhai, or Pama Bhai, or say the other Supreme Court decision in 1987, or Lingamallu Raghu Kumar, the Supreme Court decision of 2001. So the number of decisions were, right, from High Courts to Supreme Court, the Dynamic Enterprise Karnataka High Court and G. Seshagiri Rao of AP High Court, including the 2016 edition of Sharda Teddy Products Limited, the Chennai IIT. So all these years, for 2-3 decades, if a partner receives more than his capital on account of either dissolution or say reconstitution, retirement, nothing is taxable. The courts held. So somehow the government thought a partner is giving away his right and receiving more. So that also the cash portion also must be brought to tax. So that's how these sections are there. So now all these years, only at the time of dissolution, if a capital asset is received by the partner. So now this 9B wants to cover. 9B wants to cover specified entity transfer. Specified entity is specifically defined. What is the specified entity? Specified entity, whether partnership firm or AOP or BOI. Any specified person, in the case of a partnership firm, partner, in the case of AOP and BOI, a member. So the new provisions are covering these 3 entities also, partnership firms. For our limited purpose, let us talk about whenever we read the section as specified entity, a firm, and specified person means a partner for our just understanding. So this 9B covers capital asset and stock in trade. So they used the word stock in trade. Whereas in 2019, a mirror section of 45.2 was brought in the business head, section 28 small 6a. So what is 45.2? 45.2 under the capital gains chapter, if any person converts the capital asset into stock in trade, the word used, then it's also liable for capital gains, but the capital gains payment will be in the previous year in which that stock in trade is sold as part of the business activity. So the business income and the capital gains income should be computed and paid in the year in which that stock in trade, either fully or partly, sold subsequently after getting conversion. So mirror image of it, the opposite, what is it? Stock in trade converted to capital asset was not there in the statute book all these years. So in 2019, they introduced under the head of business, the charging section 28, small 6a. What they said? If the inventory is converted into a capital asset, they didn't stop with that. The 28.6a says, if the inventory under the head of business, what is business income? Business income includes the fair market value of the inventory converted or treated as a capital asset. Then the inventory's fair market value from 2021 assessment year under the head business for conversion. To better understand, for example, a real estate company is there. It will construct a big mall, intends to sell 90%, 95% they would have sold. What all they have constructed? Maybe one building, one shop, they will keep for their own office. Then which was meant for sale, if it is used by them for their own office, then inventory is converted into a capital asset. So that was subjected to tax for mere conversion. Earlier, for such conversion, there was no taxability. So the conversion was brought only from 2021 assessment year of an inventory into a capital asset or treated as, either conversion or treated as. Now, with relation to our subject, if a partnership firm transfers out of its inventory one asset to a partner, the same shop, let us say a partnership firm constructed several apartments or say several ground floor shops also. So one shop, it wants to give to one partner. So the inventory is given. Why we are comparing? All these is 45.4 what we are saying under the capital gains chapter. If a capital asset of a firm is given to a partner, but what here it is given? An inventory is given to a partner. Will it not come in this 28.64 from 2021 assessment year? So the inventory, if it is treated as or converted as a capital asset, which is the mirror image of 45.2, was introduced there. There they used the word inventory, but here now they have used the word stock in trade. The word used in 45.2, the stock in trade is used now in this 9B. So is there a difference between inventory and stock in trade? The words, in my view, otherwise why? In the definition of capital asset 214, they excluded the stock in trade, raw materials, consumables. So 3 words they have used. If stock in trade includes raw material, which we call together as inventory, they would not have used capital asset definition for more than 5 decades is there. Capital asset definition, more than 5 decades you are seeing, is there, which uses stock in trade, raw materials, and consumable stores. So the word used here in 9B is, though they imported the old 45.4, replacing with a new 45.4, they brought this 9B just like a charging section, saying, in the case of a specified entity, in connection with the dissolution or reconstitution, if a capital asset or stock in trade is transferred and that specified person is receiving, so the 9B is deeming the fair market value of such a transferred assets as the full consideration, and the income shall be charged under the respective heads. That is, if capital asset is transferred and received by the specified person under the capital gains chapter, if the inventory is, that the stock in trade is transferred under the head profits and gains of business or profession, is liable to tax. This is what it is there. So this is, instead of old 45.4, a modified one with a business head taxability is there in nutshell in 9B. It didn't stop here. The firm has to pay because firm is transferring. Firm was the owner, partner is becoming the owner, so transfer. So either capital gains or business head income, all right. But in addition, they introduced a new 45.4. What is this new 45.4 says? This new 45.4, only in the case of a specified entity being reconstituted and a capital asset is received by the specified person, or a cash is received by the specified person, then for the sake of receipt by the person, again capital gains have to be computed. This is the new 45.4. In other words, this 45.4 is charging to tax what? All these is what is not taxed. What is not taxed? The partner is giving away his right and receiving something. It is also a asset, capital asset. A firm's, a person's right he is surrendering. He got the right for some consideration. His investment is capital. Now over and above his capital he is receiving means he is foregoing his right in the firm. So for the sake of foregoing he is receiving something, that is also now for the first time brought to tax. All this is, it was not there. As I said, including cash. That's why in part 5.4, at the time of reconstitution, if the capital asset or cash and or both, if a person receives, then the capital gains have to be computed under 45. As a normal person, one receives consideration, the capital gains have to be calculated means what he is foregoing is the basis. What here it is foregoing the right in the partnership form, which he got by agreement having invested. So that right's value, if it is more than what he has invested, what he is receiving back as consideration, put together, the excess consideration what he receives must be subjected to tax. Then the right, how many years he was having, should have been the normal consideration. Under capital gains chapter, what we try to understand, if the asset is transferred, capital asset definition we have seen once again. If the asset is transferred, the holding period of the asset will decide whether it's a short term or long term. Different, 1 year is there, 2 years is there, 3 years is there. Different assets, different thing. Listed company shares 1 year, the others movable property 2 years, other private shares 3 years. Like that, you have a number of period of holding. Definitions section, you will find short term capital asset, long term capital asset. And so here the partner, how long he was there? By surrendering his right, he is receiving something more. That should have been the consideration. The whole complexity of the problem is reverse. For how long he was a partner is immaterial. What he is receiving is on account of the remaining assets in the hands of the firm on account of the value that increased in the remaining assets of the firm, apart from what he is taking, whether it is cash or capital asset. Because of that, the increase is there. So the nature of capital gains working, a particular formula is given in 45.4. So with that formula, when you arrive at the capital gains, what is the nature of capital gain? Because capital gain shall be either short term or long term taxation. So to arrive whether it is short term or long term, what are the remaining assets in the hands of the firm on account of whose higher valuation only the retaining partner is receiving the outgoing partner is receiving the money. Based on the nature of those assets, some clarification is given. So this is 45.4 and again read with the 48. What is section 48? As we all see, 48 is the computation mechanism. The computation mechanism under the head capital gains. Because taxing statute, charging section, how much is important, computation mechanism also is that much important. Because if the computation mechanism fails, though there is a charging section, if the computation mechanism fails, taxability will fail. That's what B.C. Srinivas Shetty Supreme Court decision still holds good. That's why we have seen a number of capital gains, say section 55. Some assets where cost of occupation is zero. Specifically, the capital gains chapter says, for these type of assets, cost of occupation, take bonus shares, cost zero, and then compute the capital gains. So, specifically. So now, this computation mechanism, section 48, what is the cost? Because the tax liability is now vested in the specified entity, in the partnership firm only, in both the cases. In the first case, when the assets like capital asset and stock in trade are transferred, the firm is liable. Actually, the firm is the transferor. Whereas in 45.4, who is the real transferor? Partner is the transferor. His right he is transferring to the firm, but here also the firm is made to pay the tax. So having firm paid the tax, you may call it a double taxation. So having paid the tax, firm is given the benefit of whatever the value for which the firm paid, that value will be attributed to the remaining assets in the hands of the firm with 3-4 conditions. What are they? We are slowly going to see. So the 45.4, whatever the tax the firm paid, because it is on behalf of the partner, outgoing partner is paying, to make good that benefit, the value that is increased value on which the firm is paying, that value shall be apportioned and allocated to the remaining assets on a particular basis. So this basis to give, new rules have come. The rules were given on 2nd July 21. The act was passed. The rule making power is there in section 9B. And then the rule making power is now given in rule 8AA5. What is the nature of that capital gain? So you arrive the amount, the formula is given in 45.4. After arriving the formula amount, then what is the nature of it is given in rule 8A5. And then how to attribute that value to the remaining assets, the new rule 8AB is given. So how to attribute it? 3 conditions are there. Those 3 conditions, like form 5C filing, before that registered valuer as per rule 11U to take a valuation report, and that attributed value is not eligible for depreciation. So like the conditions are there, which we are going to see. So I have given you an overall view that the 2021 Finance Act, applicable from 21-22 assessment year, has brought in something which the government thought was escaping taxation. But while bringing this, lot of areas or interpretational issues or say practical difficulties are there. For example, these sections take, at the time of dissolution, a partner receives something. But if you see the partnership act and if you see the reality, without receiving anything also dissolution takes. For example, a partner has overdrawn his capital for 2-3 years, he is not making good his debit balance. What the other partners will, instead of you contributing something, you don't work, you don't contribute, you have already overdrawn. Then what the other partner should do? By compulsorily send him out. So, is he going to receive anything more? Or can we say already debit balance what he is receiving the benefit? Can we say? In the Partnership Act, specifically section 41, if a person becomes unsound mind, firm has to be dissolved. If a person becomes a partner, not a person, if a partner becomes unsound mind, firm has to be dissolved. If a partner becomes insolvent, firm has to be dissolved. By chance, all the partners have become, there are 3 partners have individually become insolvent. Please see, I'm hypothetically giving. There is a firm, 3 partners are there. All the 3 partners, not this business is solvent, firm is solvent. 3 partners in their individual capacity have become insolvent. The firm has to be dissolved necessarily. Then the firm's assets, to whom they will pay? They have already become insolvent, on top of which only the dissolution is taking place. To whom the firm's assets, the firm has to pay? To the creditors of those individuals. They are not receiving. Creditors are receiving the firm's assets. Firm is paying, discharging its liability because they attach to courts. They right in the firm. So, at the time of dissolution, really the partners receive what is contemplated. In the ground reality, there may be something different. So, different situations are there, which my senior, say, co-paper presenters, they will elaborate. My job is to explain the basic provisions. So, while you are understanding the basic provisions, you please be thorough with these provisions. Thereby, when they come for interpretational issues and they show you the different calculation, different models and different things, you must be able to understand them. So now, this I have already explained. Once again, at the cost of repetition, I say, so the 9B and 45(4) are the 2 different capital gains and the business income provisions. So only in 9B you will have, apart from capital gain, business income also, because 9B talks about transfer of the specified person, that is a firm, partnership firm, both the capital asset and stock in trade by chance. So earlier you are having ALA firms, check the trading company, the decisions of the Supreme Court, old decisions, the inventory should be taken at market value. So the fair market value. Fair market value is defined in section 222 capital B. That is in the open market by sale, the price that it's going to fetch is the fair market. In case it's not available, through rules specified, the fair market value has to be accepted. So the 9B talks about receipt by the specified person, the partner or AOPBY. Generally, AOP is normally, intentionally, people will not create AOPs, to my mind, my practice. Only in a search raid you will find the AOPs. Why? 2-3 people jointly invest in something, whether legal or illegal. A real estate business also, let us say. On paper, 3 persons purchased the land, 3 persons sold the land will be there. But actually, in search you will find a day, all the 3 persons incurring some legal, illegal expenses and doing some business, paying some commissions. They would have carried out some activity. Then assessment shall be individually they cannot, because together they have done. So 2 or more persons with an agreement and evidencing the partnership of the 184, 185, who see the income tax sections, the firm deed should be there, an agreement in writing. For AOP, nothing will be in writing. Deed like thing, agreement like. So then it will be. So AOP number of decisions are there. What is AOP? What is not an AOP? So in all such cases, if the capital asset is received, transferred by the specified entity, that is a partnership PY, and received by the specified person, either in connection with the dissolution or reconstitution. Reconstitution and reconstitution is defined in 9B itself, section 9B itself. The reconstitution is defined, as I told you, either a new person, new partner is coming in, or old partner is going out, or the existing partner's profit sharing ratio change. So then this 9B, 5 subsections. So first section says the in connection with the dissolution, if the capital asset or stock in trade is transferred. So then second and third, they go on saying, well, the fair market value of those assets as on the date of such a transfer, that is a receipt, as on the date of such a receipt, is the full value of consideration for calculating either capital gains or business head income. And the firm has to pay the tax. Whereas in 45(4), the receipt of by the specified person of either capital asset or cash. So in 45(4), specifically mentioned in the explanation in 45(4) that though this is already covered by 9B, capital asset transfer is already covered in 9B. Second time again in 45(4) it is mentioned, in case capital asset is transferred as per this formula, you please calculate the capital gains. So specific formula is given here in 45(4), whereas in 9B, no such formula. The transferred full value of the consideration and respective heads calculation, the income has to be subjected to tax. That is either under the business head or business head charging section 28 or the capital gains charging section. So for the capital asset transfer. So naturally, capital gains charging section is 45(1). So the 45(4) is a special section which starts with a non-abstention clause. 45(4) says, notwithstanding anything contained in these other provisions, this 45(4) shall be calculated. So this 45(4), it starts with non-abstention clause, notwithstanding the other provisions. So here also the firm has to pay the tax, but the firm is given the privilege, advantage of increasing the cost of the other assets as specified under section 1, because cost of acquisition, section 48. So the other assets, cost of acquisition, but conditions are there, just like a normal cost of acquisition not be there. Those conditions are there, which we will see. Then the not the cost, indirect figure, as SIRC has rightly said, those assets ultimate sale in future, sale value shall be reduced, that is said. Don't add to the cost, but sale value to be reduced. So ultimately when you are selling, the difference between the cost and the sale price normally. But because of this application of 45(4), in future if you are selling from the sale value, this apportioned, increased, already tax suffered value shall be reduced from the sale value. That's what the exact wording is given in this. So the specified entity, I have already told you, AOP, BOI also included apart from specified person, partner or the member, and the two words also, self-generated goodwill and self-generated asset. So self-generated goodwill means, because this is so important here, as I told you, earlier people used to pay the money to the partner, excess money, debit to the goodwill. So here they want to curb this. So they say self-generated goodwill means not purchased, incurred cost. You are simply creating an asset. Either you are transferring the asset, for the sake of that self-generated goodwill, you are paying the money. So self-generated asset means generally trademarks, patents, so that intangible assets. So these are also being dealt with here. So something special is there in these three sections. So how well going for workings, we can see these things. So the reconstitution, as I have said, the three situations were also defined here. The reconstitution words as they are there in 187, they are repeated only here, mostly. So it is very, very, very minor modification. So these the words. And then we are having a reconstitution reform examples also are there. So then the profit sharing, mere profit sharing ratio change also. Not necessarily all the partners. Some, if 4 partners are there, 2 partners profit sharing ratio may not change. Only the other 2 partners profit sharing ratio may change. Then also it's a reconstitution. But on the occasion or in connection with the reconstitution, something should move from the firm to the partner. Then the event of happening and something transferring, both should take place. Then alone we have to calculate these things. This is the 9B. And then the taxability in the hands of the specified entity, that is a specified person, there is either in connection with the dissolution or reconstitution, and then the asset, capital asset or stock and trade value, the fair market value has to be taken. So it is a deemed transfer. Deemed transfer, the words used in 9B1R. So we are having, for the sake of capital gains only, a definition of transfer 247. So the 247 having several sublimbs, definition of transfer for the sake of capital gains. But business assets also can be transferred. So for business assets transfer, the common general parlance of understanding of transfer only we are trying to understand, not the definition of transfer, because the definition of transfer is only meant for capital assets. So here the 9B says, in case the capital asset or stock in trade are transferred by the specified entity, such entity, specified person, to the specified person, number 1. Number 2, deemed to be the income of the specified entity. So, and then 3, at the fair market value, shall be taken as the full value of the consideration. So, the consideration for capital gains, in some sections you would have seen in the case of immovable property, instead of saying the fair market value, for example, 50C, 56,210, 43CA, SRO, sub-registrar office value, the government registering authority value shall be taken as the full value of the consideration in case the actual consideration is lesser than the SRO value. So here they didn't say like that. So fair market value shall be taken of such assets. So that is this thing. And then 4 and 5, the power, the central government's power to issue guidelines. So that is the board, as per these guidelines only, has issued, framed the rules and issued the guidelines which are to be placed before the parliament. That's what they have said. Though the silent features of this 9B we have been trying to understand. So the either business income or capital gains income under the respective heads we have been trying, we have learned and we have been calculating. But now, as per 9B, we have to calculate. As per 9B, we have to calculate the capital gains or the business income with respect to these specific situations. So that is this thing. So the receipt of a capital asset or stock in trade. So when the act is so specific in this 9B, other than this, is there a possibility of the person receiving at the time of dissolution? Possibility is there. So you are covering in 45(4) only the cash, apart from this capital asset. Apart from capital asset and stock in trade and cash, can't there be other assets in the firm? Can't there be the other assets being transferred to the partner? Natural, there may be, for example, the book debts, sundry debtors. Normally, if a business is carried on, 2, 3 partners, 4 partners, each one will be looking after some division. One purchases, another one sales, so another one the management, like that manufacturing. So at the, in case by chance someone is retiring, liquid cash may not be there with the firm. Then what do they do? Particular debtors, we are assigning you to collect. So if such assets are also given, either at the time of dissolution or reconstitution, will these sections apply? Because specifically the section says only these 2. Then for others, we have to presume that it's not affected. But anyhow, the other sessions, these things will be discussed in detail. So 9b talks about only capital asset or stock in trade being transferred by the entity and received by the person. So the income shall be determined under the respective heads only. So the would you restrain to the method to be followed for calculating. So under the respective heads only, it is being subjected to charge. So the reconstitution once again explained, and the business profits shall be chargeable under the respective heads. So then the at the time of dissolution or reconstitution, not necessarily firm entity will be one. There will be 2 outgoing partners. Out of 10, 2 may go, 3 may go. So then different situations, different assets. So how to deal with all these things? A complex problem. So sir has given some examples, but anyhow, we can see that, because we have to conceive that it's not that simple as we read. At the time of dissolution, one partner is going out, we can. There may be a possibility of different assets to different partners maybe being given. So then we'll go to 45.4. So this 45.4, the second new section, the given scenario, 45.4 says, notwithstanding anything contained in subsection 1, 45.1, the general charging section. So don't go by the general charging section. I am specifically saying that where a specified person receives during the previous year. So the triggering point, both in 9b and 45.4, not the event happening of dissolution or reconstitution. Receiving is the triggering point. So receiving, where a specified person receives during the previous year any money or capital asset or both from a specified entity in connection with the reconstitution of such. So here dissolution is removed. Only reconstitution is touched upon. So there reconstitution and dissolution in 9b we have seen, whereas here only reconstitution we have seen. So we are going to see the coming slides, the difference between 9b and 45.4 for our own clarity. We should not get confused, because something there is repeated here, something there is not repeated here. So 9b and 45.4. So we should be thorough with these provisions. So if such thing happens, then any profits or gains arising from the receipt of such money or such capital asset shall be chargeable to income tax as income of such specified entity under the head capital gains. So for cash receipt also, capital gain shall be calculated as per the formula and shall be charged in the hands of the specified entity. Capital gains shall be charged. So the mere cash receipt, no question of capital asset, let us say. A reconstitution, only cash is paid to the outgoing partners. Then 9b will not apply, because cash is not dealt in 9b. So no asset is transferred, only cash is paid, outgoing partner. If such payment is in excess of the capital, which capital account? On the date of happening. So that capital account, normally what earlier we used to do, or generally happening. So the revalue the assets. For example, 10 years back floated partnership form. If a person wants to retire, on which value he will retire and receive something as on the present day value. So present day value means they revalue the assets. So the revaluation entry they pass in the books, increase the retiring partner's capital account and pay the money. So now for this 45.4, such revaluation increased capital account don't consider. Without revaluation, what was the capital? That capital only you consider for calculating the 45.4 capital gains, specifically says, as per this formula. So now we are going to see that formula. So there is notwithstanding anything contrary contained in this act, such profits or gains shall be determined in accordance with the following formula, namely. That's what we are going to see. So the formula is actually A is equal to B plus C. It is there in the section. So this A means the capital gain income. How much income? B means the cash, the money received. Cash means not physical cash, through bank check also. So the C is the fair market value of the capital asset given. So fair market value already you have dealt in 9B while calculating the firm's capital gains tax liability. That fair market value you also now consider. That means the capital gain now you are calculating the partner receiving cash plus fair market value, B plus C, minus the D, the capital account balance that is outstanding, that is credit balance available in this capital account of the specified entity at the time of reconstitution. So this is the capital gain. How to compute the capital gain? This 45(4), no discretion is given to the entity, formula is given. We have to calculate. That's why they use the word notwithstanding. Otherwise, a capital gains calculation mechanism is given. That mechanism you should keep aside and give this thing. So the first proviso to 45(4) says, in case such A, the value of capital gain is negative by chance. That means his capital balance is more, his cash received plus capital asset fair market value received is less than the capital balance, it becomes negative. In case it becomes negative, ignore, no capital gains. It didn't say capital loss. If positive comes, pay the tax. If negative comes, take it as 0. Nil. The first proviso to 45(4) says. So the second proviso provides that the balance in capital account of the person shall be without considering the revaluation credits. So before reconstitution or dissolution, not dissolution, before reconstitution, normally what we do? We revalue the, because age-old assets, so real liability. Revaluation in the sense, any number of times may be positively higher side may come. There may be lower side also. Some assets would have value decreased. Book value is more. Your debtors, you have been decoratively putting debtors either for bank loan or for outsiders. But when the partner really retires, those debtors are not realizable, like bank NPAs, something is NPA. Then what you have to do? Revaluation gives a negative figure. That also should not be taken actually. So the section simply says here, revaluation effect shall not be there for capital account. Without revaluation effect, the word revaluation itself, already some value is there. You are again doing the exercise, then it is revaluation. So some of our senior authors have on this subject said, where is the revaluation? Sometimes valuation itself is not there. As time of retirement, valuation of some assets which are not brought into the books of account, like work in progress or some rights accruing on account of contracts, dispute is there. You want to claim some additional compensation. Those things are not brought into books of accounts. But when a partner is retiring, if not today, tomorrow you are going to receive such money, come and value it. So it is not a revaluation, it is a first time valuing means valuation. So here the section says that revaluation you ignore. Then shall we, valuation itself shall we ignore or not is a debatable thing which we can see. So then, especially for the self-generated goodwill or self-generated asset without taking into account. So then the 45(4) features, once again, the non-absentee class, I have already told you, the formula is very specific. So with this formula only you have to calculate. No, you should not go to other comparison of other sections and then other methods of this thing. You should not go to. And then the fair market value, as we have already seen, the definition 222B of the capital asset. For 9B, what is the fair market value? Here also the capital asset, fair market value. The definition itself says the capital asset would ordinarily fetch on the sale in the open market on the relevant date. And where the price referred to, one is not ascertainable in the open market, the price is not ascertainable. Then the question of arrival. So like we are having 11U, 11UA. If a quoted share, price is available in the open market. If it is unquoted share, go by the individual assets and then unquoted shares value arrive. Like that they say, as per the specified rules, the value has to be arrived. So then rule HAA 5. So rule HAA subclass 5 is newly introduced. What is this? For method for determining the period of holding in case of amount chargeable under 44. So as I have told you a few minutes back, first capital gains on the transfer of those two specific assets, capital asset and stock in trade for business income, 9B calculation once you do. If it is a reconstitution, again come back. If it is only a dissolution, you need not come to 45.4. Stop with 9B only. If it is a reconstitution, after 9B, come back to second time 45.4. So in this 45.4, once again you are calculating, but actually this is the capital gain of partner, not the capital gain of firm. So capital gain of partner charged in the hands of the partnership firm. So because it is charged, a benefit is given to the firm to attribute the value to the remaining assets. So this HAA file, before going for the attribution HAV, HAA says, what is the nature of that? Capital gain you have arrived. Okay. But the capital gain nature, whether it's short term or capital gain, you have to determine the tax. So to determine the tax, actually I have forgotten, the capital account balance in case of 45.4 shall be adjusted for the 9B tax what you have paid. That gain should go to the credit of the capital account. Say for example, 4 partners are there. So one partner is going and asset is given by the firm. So the asset, because of its higher value, gain has come. So that gain, what is the portion of the remaining part of outgoing partner? 1/4. So the outgoing partner's capital account balance, what you have to calculate, should be increased with the book balance gain of the particular capital gain what you have paid. So that gain shall be credited, proportionate gain to the profit as per the profit share of the partner retiring outgoing shall be increased to arrive this capital balance. So in the problems worked out, Sir has most clearly dealt it. So the amount of a part of the gain shall be deemed to be from the transfer of short-term capital asset if it is attributed to. So in 45.4 formula, we got the gain. To arrive the nature of the gain, whether it is short-term or long-term. So this rule 8AA says, to arrive the nature of the gain, first, what is short-term? If the increase revaluation is with relation to a capital asset which was remaining with the firm as a short-term capital asset, that proportion shall be short-term gain. The gain amount we are going to divide into short-term and long-term. So first 3 items are given in short-term. So what are the 3 items? If the remaining assets in the hands of the firm for whose revaluation has gone to increase and thereby the partner got the benefit. So if that asset is a short-term asset, to that extent it is short-term. Capital asset forming part of the block assets. We are having the block assets theory. Fixed assets, depreciable assets used for business. Instead of each individual asset, all the depreciable assets of a particular rate, particular nature shall be grouped as a block. So in that block, some assets value has gone up. So your depreciation normally, as per accounting principles, say, but in the market, that asset value may go down or asset value may go up. So in case of depreciable assets sale, or in case of depreciable assets now considering the gain, always depreciable sale shall be taken as section 50 short-term capital gains. So the depreciable assets sale shall be taken as short-term capital gain. So if the value attributable is relating to depreciable assets, then in the block of assets, so it shall be taken as a short-term capital gain, second nature of short-term capital gain. The third nature of short-term capital assets. Capital assets being self-generated, that means goodwill is first time you are revaluing, or your self-generated goodwill Maybe second time you are revaluing. Already in 1 year, say 21, 22, one partner retired, 22, 23, second partner retired. So same again goodwill, you are revaluing. So self-generated goodwill or self-generated asset, because of its value increase, you are paying something to the retiring partner. In all these three occasions, the proportionate capital gain shall be taken as short-term capital gain. So then the remaining thing is any other asset. If it relates to a long-term capital asset, long-term capital gain, or any other assets, the long-term capital gain. And in case the partner outgoing is taking a asset related to a higher value, please don't consider it. No attribution, because asset is not there in the hands of the firm. He is taking away. For that increase, don't consider. So if both are there, combination, some short-term assets, some long-term assets, arrive a formula. Total increase how much? Total capital gain how much? So for total increase in 4 assets, your capital gain arrived is this much. So as per the formula. So then if ratio you form for each individual asset also based on the increase, that's what proportionately they said. So now, sorry. So the 48.3 gives the basis for attribution. So 45.4 refers to 8AA rules.
Just you can mention also, double taxation is permissible in 90 and 45.
Yes, specifically in this 45.4 explanation too, they said, though it may be a double taxation, it's permitted. That is one income, can it be taxed twice? Actually, pardon sir?
Dividend income is already taxed twice.
Dividend income in the same person, it is not taxed twice. Here the same person is taxed twice. That is the dividend income in 2 different persons' hands. Tax here. Say, for example, I have gone through one case law, just like an AOP. 3 persons purchased the land in acres. Maybe 10 acres, they bought 3 persons together. They lay out the house plots. They sold. They go to one auditor. One auditor says, why you worry about the 2 other partners? Your 1/3 share, admit as capital gains, file the return. Don't worry. So after some time, the income tax department issues a notice to all the 3 persons. You 3 gentlemen, you are very kind enough to pay the taxes individually, but the law says, if an entity has not paid the tax, second time also, we got the right to collect. As an AOP, all the 3 of you once again calculate, once again pay. Law, decided case law is there. Sir, approves or not. So there you are paying second time, no? Nothing doing. You have to pay. The refund claim period or something revised, everything over. After 3 years only, because the present regime government, as much leisurely we give the notice, that much higher money we get. So leisurely only they give the notice, leisurely they collect the money. That's what is happening now. You are seeing in March 22, lakhs of notices, 148 notices relating to 14-15 assessment year, 15-16 assessment year. So second time also the law says, because you have already paid, you are exonerated, nothing doing. The income tax act, if they want to collect second time, they collect. That's what the double taxation is specifically meant for it and specified it. No question of giving any concession. So the CBTD, apart from the rules 8AA and 8B, 8AA to determine the nature of the gain, short term or long term, 8AB to arrive the proportion, in which proportion, say, the attribution shall be done. So the attribution doing means, what is it? For the remaining assets, in future if they are sold, at that time from the sale price, what is to be reduced is attribution. So it is all ifs and buts. So as if a promise made on the same day, next year, if it rains, I promise you to pay 1 lakh rupees. So these are the contract that we see the impossibility of performances. So really, is it possible for somebody? So, yes, sir.
So my question is, it should be critical requirement for taxation is withdrawal of cash or kind, right? Supposing Among the partners, there is a father and child.
Hmm.
Father has passed away due to old age.
Hmm.
Assets are the partner his balance is transferred to the child within the partnership
Hmm.
constitution.
Hmm.
In such scenario, will this
Nothing is received by him. So, see, actually, the reconstitution is taking place. If a person dies, reconstitution takes. But if only two partners are there, your example, father and son are there, father died, definitely capital gains will arise. So there are
no,
they,
son
they,
takes another partner?
so one minute, sir. What I advise, if at all some properties are there, but don't run the firm with two partners. Always have them, because there is a possibility of one partner suddenly going away. So if three partners are there, automatically, if only two partners are there, dissolution is a must. If only two partners are there, dissolution is a must if one partner dies. So the legal heirs automatically coming into the baby as per the original terms or by the mutual agreement also. So because there should be in the partnership form general precaution what we give, invariably we write the death of a partner shall not ipso facto dissolve the firm. This clause as a rider, right? Why? Because if it is a dissolution, two returns for the same financial year you have to file. One form is succeeded by another form. So to avoid that only one form, though there is a change in constitution, invariably we write in the partner bit, death of a partner shall not ipso facto dissolve. Sir, please supplement sir, the questions.
The only point is, the question you are asking is whether where the money is or the assets are paid to the legal representative of the deceased partner, correct?
It is not paid, it is just transferred within partners.
Is the son also a partner?
Yeah.
If the son also is a partner, if you look at 45(4), it says the amount is being received by the specified person. Specified person is a person who is an outgoing partner. Unfortunately, the law is a bit rationalized that in the case of a death of a partner, 45(4) will not apply. Even section 9B will not apply because the person who is receiving the asset or the money or even the capital balance is not the specified person as defined. So there is
A similar
like
feature in death can happen where the property, rental property is in the name of the partners only, but the property is used by the partnership to lease and other things. Say 4 family members are there. One person due to old age dies. The remaining 3 people continue to receive rent. As such, the property is still there in the name of the senior person or whatever.
no, the only point is this. Who is the specified person? The specified person is a partner who is outgoing, or in the case of dissolution, all the partners. If the person in receipt is not an outgoing partner, there is no question of applying 45(4). That is the answer.
So, sir, clarified now, sir. Only two partners are there means it is inevitable. One person dies means even if clause is there, death shall not ipso facto dissolve the firm. Also, the firm gets dissolved because no more is the firm is continuing.
But if you add another partner,
At the time of death, if you add, it's not right. Again, new firm is coming into existence. Old firm ceases and new firm is. If already 3 partners are there, one dies, firm is continuing, then you admit the third. But if 2 partners are there and the death, if write a new partner date, the old partnership firm is going and new partner firm is coming. So that is the answer. Yes, madam.
So in the case where there are 3 or more partners, if one person is dying, in that situation also this 45(4) and 90 will not apply.
No. You please read in conjunction, in the sense don't individually see. 4 partners are there, 1 person dies. What your partnership deed says? Number 1, death shall not dissolve the firm. Okay. Then it amounts to reconstitution. Reconstitution can be, if you on account of death, if the deceased person, the partner who was there at the time of that reconstitution, it amounts to reconstitution. Is he receiving anything? He is not receiving anything, no? So then no question of 45(4). That's what SIRC says. So if he receives anything, that's also the occasion may be there, but is he receiving? He is not receiving, nothing is there. Okay. Like I will put in simple terms to you. Section 47 transfer, which are not considered as transfers for capital gains. I am a living person. To an unrelated person, if I gift freely also, it is a transfer. So definitely the receiver 56(2)(10) will apply. I write a will after my death, my property should go to an unrelated person. No question of capital gains. Same thing is happening, but death, passing on, succession, difference is there, no? Happening may be the same thing. Sir.
So that means, I mean, just asking practical example. Partner has died in a year, but the same PAN number, the business is continuing. Can you find, you have to find 2 returns?
You are sorry. If a partner died and the same firm, same PAN number, you are continuing, you should have reconstituted and that new deed should have been entered into. See, the partnership firm taxation, section 184 to 189. 189. So this, you should go through those sections specifically. There, what is reconstitution? If dissolution takes place, what will happen? In the dissolved form, 189 says, in the case of a dissolved form, the assessing officer can deem the old form is continuing for the sake of assessment. Are you able to understand? That is 189. So the chapter, section 159 to 189, special liability, tax liability in special cases, one chapter is there in income tax special. That chapter normally we don't touch here. Only when occasions like this comes, we'll touch. So, sir, now let me continue and in another 5-10 minutes, let me complete. Then I will come back to finally in 5 minutes, let me complete. I will come back to the questions. So, this rule 8AB, what it says, the amount chargeable to tax shall be attributed to the remaining assets. So, this attribution sake, say, the more intention and clarity has come from the CBTD circular number 14 of 2021 issued on 2nd July 21. So here it says the original intention capital assets is 48 refers to the cost calculation. So here for 43(6)(c) also shall be block assets also shall be given. That means though it is depreciable asset, so it can be taken. But the 2 conditions what they have said, what is the amount attributable related to block asset shall not go and join with the block assets for claiming depreciation. It will be separately there. So similarly, the goodwill it will be separately be there. So not eligible for depreciation. So this circular clarifies all this. It is a clarificatory thing. So for operational convenience. So the self-generated asset and self-generated goodwill also, for example, we have seen the trademark. It's for its increase in the value, realizable value, you have paid something more to the outgoing partner. But that increased value attributed shall not be eligible for depreciation. Only subsequently, if it is going to be sold in future from the sale value, it shall be reduced. That's what 8AB 2 and 3 will be there. So the proportion it should be there. And the 3 conditions what I said, the 8AB, the revaluation shall be only with the valuer's certificate you should have obtained, not your assessor's valuation. Registered valuer's value shall be obtained, and the does not entitle for depreciation. I have given highlighted words. So the second condition is they are not eligible for depreciation, and the third condition is Form 5C shall be filed before the due date. Many number of times the due date is so crucial nowadays. For example, from 2018-19, 80 AC section was amended. Thereby, under section 80P, earlier few sections were there. So any cooperative society, if it wants to get 80P benefit, it should file the return of income before the due date. After the due date, if you file, though with the tax audit report, the 80P benefit will not be there. So similarly, in the charitable trust also, section 11 exemption, if you want to claim, before the due date, you should file the return. Similarly, here, if you want to get the benefit of double taxation, you want to mitigate and want to avail the benefit of this thing, you have to file Form 5C electronically before the due date of filing of the return for the previous year. That is the assessment year's due date. Okay. So these are the conditions. So the examples are there given in this CBTD circular. So these examples, again, sir is going to repeat, Ramasubramanian sir in the third session, the same examples. Say for example, this thing, if two partners are there and then equal partners. So one partner, two assets are there. So if you are going to calculate for 9B, indexation is also capital gains chapter. For example, one long-term capital, two land pieces are there. One land piece to a retiring partner you are giving. The land cost will be something. Land fair market value will be something. But because it is a long-term capital asset, with indexation you should deduct and pay the tax. So here in the given example, in the circular, CBTD circular, it is given. So the fair market value of the land transferred is 50 lakhs. Index original cost though it is 10 lakhs. So 15 lakhs is the indexed cost. So on the fair market value, 35 lakhs you will pay, assuming 20%, 7 lakhs will be the income tax you pay. So now for 45B, the same thing if you are going, then the value of this increased tax paid, the gain, book value gain means 50 minus 7 plus the original cost 10. So 50 minus 17, 33 is the gain. 33, if there are three partners, equally 11 lakhs each individual. So the capital account balance over and above the capital account balance, what he receives under 45(4) only is second time capital gain. So his capital account shall be increased. Already 9B one tax you are paying. With the 9B, the tax paid book value increase shall go to the credit of the capital account. So this is the thing. So similarly, instead of giving the at fair market value a capital asset to a partner, if the same asset sell to a third party, realize the money and give that money to the retiring partner, then also in these calculations of either 9B or 45(4), no change will be there. Whether you give purely cash, whether you give fair market value asset, in these two examples, what they said, there will not be any change. So like this, the examples, 3 examples are given, but around 12 examples our Ramasubramanian sir is going to deal in the third session after the lunch. So this is the some Pradeep Kapasi sir has come from Mumbai. Welcome you, sir.
Thank you, sir.
So the first example, asset is given. Second example, asset is sold at the same fair market value and money is given. Even then, the tax liability and calculation will not change. So the another third example is given. So then, to which asset it is to be attributed? That is the example. So this CBT sector has given this third example. Thereby, it is saying that if it is a short-term capital gain, it shall be attributed. So, for example, 2 assets are there: self-generated goodwill and a trademark. So, proportionately, the increase in the goodwill, say 20, and in the increase in the trademark is say 40. So 20:40 is the ratio. So with this, whatever is the tax that suffered under 45(4), in the same ratio for these assets, which are all the remaining assets with the firm, you have to allocate. Allocate means a separate thing will be there, but not eligible for depreciation. So with this, my presentation is over, but actually questions, sir, your questions.
Suppose reconstitution of the firm, partners continue, but you are not taking out any capital, letting in the firm run as it is.
Okay.
Then there is no question of
1 rupee tax need not be there. Your question I am repeating for others' benefit. Some partners are there, 4 partners. Reconstitution with profit addition, profit sharing ratio addition will be there. But no partner is going out, no partner is receiving any asset. Only reconstitution takes place. No question of taxation. So if something received by is there occasion to do the taxation. Otherwise, all the assets are there in the same firm, no question of.
And one more case, the partner retires, but he leaves his capital in the firm, and I take this slowly over the period.
Sir, if a partner retired is leaving the capital means it amounts to a loan. The partnership act within 6 months shall be paid is there, partnership act, but he is leaving the money means he is no longer a partner, he is leaving the money, he is not receiving anything. Only this capital account is continuing as a loan, then also he is not receiving anything. No question of capital gain.
But when he draws partially, that time the proportionate capital gain will come.
That is the question our two speakers are going to answer. In case the cash is paid in installments, in 2-3 years, or is it liable, how to calculate? The act is not contemplating this thing, or the example given in the circular is not contemplating, but in reality it happens now. At a time they cannot pay, we will pay, sir. These are accumulated assets for 10 years. Will you, because just like that you are retiring, shall I have to sell the assets and give? We will give you leisurely.
Maybe you pay interest, but you can't even take it.
So those questions in the subsequent sessions with examples were answered. Any other questions, sir?